Good morning. Good morning. Let's get it started. Hope you all are doing well.
Welcome to the show, it's Mortgage Talk. Grab a coffee, sit, and let's unlock the dreams you've got, the place you from the front porch swing to the hidden cave. Talk about your home, talk about your plan, talk about the future where you'll stand. Your mortgage, your dream, your story to give. Let's talk about the place where you want to live. Got questions? Here's the place to be. A TikTok live mortgage jubilee. Fix or float, we'll break it down. From city lights to your small town.
Happy Monday. Happy Monday. Hope you guys had a great weekend. A lot of shopping going on, I'm sure. Whether you add it to the cart or are physically going out into the world. That's kind of I don't think this thing is even working, so I'm going to take this off. We'll roll without headphones today. So my name is Kenny Murden. I am newer to TikTok. I am not new to lending. I've been lending since 1999. And a good part of what I've done in the past is I have worked in kind of like a sales managerial role with a bunch of loan originators. So if they have issues that they're trying to structure a deal or they're having difficulty in getting something approved, they can kind of give it to me for another pair of eyes to just see if there might be a solution for the situation or circumstance that they're in. And that is just kind of where I've really strengthened my ability to help you in whatever it is that you're looking to do, whether you're looking to buy or refinance, if you have issues as it comes to credit, income, or assets. There's different loan programs that are more forgiving in certain areas. So that's definitely something that we can talk about if you are concerned about those kinds of things. But also, I like to, here I'll show the display above my head. I like to show how sharp my pricing is. Rather than tell you, hey, I have really, good rates and things, I want to show you because I know that it's tough to compete with. And so if you're, currently in the market for something, we can pull up your pricing, your scenario right here live and see how it compares. So the thing that I put in here is if somebody was buying a $400,000 house, FHA with 3.5% down. The reason why I do that scenario with 680 credit score, the reason why I'm doing that scenario is because one, it keeps it consistent. So I can check if pricing has improved or got worse. And I'm going to say here in Texas, let's see, are you able to access FHA Connect and check on my loan binder for me if I give you the case number? No, I do not have access to FHA Connect, but I could have a processor or an LOA check on that for you. Sorry to hear you got something stuck there. I know what you mean there, but so I'm going to say we're in Texas and fees in, meaning there's not going to be any junk fees, no underwriting fees, anything like that. Any fees that you would pay would be a discount point, which is tax deductible. So let's take a look at what that comes up today. On Friday, it was about 5 1/8 paying a point, and that's exactly what I'm seeing here right now. And I'll blow that up a little bit. So, yep, 5 1/8. and that would cost us 1 point, which would in this case be just a little less than $4,000 on a $400,000 deal. And then if we wanted par, which means no lender fees, then I believe we were at, I need to make this smaller. I believe we were at like 5.5. Let's see what that looks like. Yep, and it's the same. So you can see all these different lenders that are pricing out with just the one scenario. I have over 200 lenders that I work with. So it looks like pricing is much the same as it was on Friday. Thank you for the likes. And again, being newer to TikTok, I forget to say, if you like what we're talking about, hit the like button, follow if you want to see, some of the content. Because after I do these lives, I chop them up into shorts and rebroadcast them on my channel as well. Feel free to share this with anybody that's looking to buy or refinance as well. And I encourage comments and questions if you have any questions about real estate or mortgage. Otherwise, I am on here from 10 a.m. to 11 a.m. Monday through Friday, with a lot of exceptions. So I try to keep to that schedule, but with the holidays and with I go on a lot of recruiting trips up to the UWM headquarters, and I'll be there this week. So I leave on Wednesday, so I can try to pop in like when I'm at the airport. I can come in on my phone. I just historically haven't been really focused. Like I really enjoy being here in my studio, in my office, and being able to present and focus on the comment section and deliver a message. But typically 10 a.m. and 4 p.m. are the time, Central Time, are the times where I'll come on live. And I don't think we're doing the 4 p.m. for the rest of the month, just because the co-host has kind of taken some time off, and I've just been busier with the holidays as well. So I'll try to come on, as consistent as possible. But right now, that's been pretty much just this hour of 10 a.m. to 11 a.m. Central. So if that works for you, or if anybody else that looking to buy or refinance a house, I'll be on here, happy to answer any questions that you may have. So other than that, some of the things that we talk about, not just the pricing that we can do live on here, but if you were thinking about refinancing, no matter what, some of the benefits to refinancing are skipping 2 months payments, getting a refund of your escrow balance if you're escrowing your taxes and insurance in your monthly payment. And then once the payment starts up again, there's likely going to be some sort of savings there. So whether that means you just lowered your interest rate, and that's going to be saving you some money per month, or if you do a debt consolidation loan where you no longer owe all of those payments to other things. Let's see, could I call you later today? Yes, my phone number is on the top. Just go ahead and save that. And again, I'm on here for just over the next 50 minutes. After that, feel free to call or text. If I'm available, I'll answer. If I'm not, I'll give you a call back. I don't really run, schedule an appointment with me kind of a deal. I just find that became less, sometimes when those appointments get missed and now I have like a free half hour or an hour. So I got away from Calendly for that reason. I just say, call or text me. If I'm available, I'll answer. Otherwise, I'll get right back to you. I usually get back, same day, unless it's later in the day. It might take, the next day. So appreciate the comment. Also curious to know where in the country you are. So if you would like to put your state where you're in the comments, that would be helpful. I'm in the state of Texas. I am from Minnesota, so I have a Minnesota phone number. Been down here almost 6 years, and I'm sticking with it. Oh, you're also in Texas. Awesome. I'm in the DFW area. But glad to have you here. And so, yeah, that's basically. Oh, I wanted to go into a little bit more detail on the benefits of refinancing. The way that works, where you skip 2 months, is, let's say you're closing today, right? So you have a grace period until the 15th of each month. So you want to purposely plan to not make the payment in close the loan early in the month. So you're paying off the loan. You don't need to make a payment if you're paying the thing in full. So that would be for December's payment. And then when you close, it collects the interest through the end of the month, which is January's payment. So if you were closing today, you could have skipped December and January's payments and kind of resets your budget that way. Now, if you were just applying today, you would purposely set it up for closing early next month. So you'd skip January and February, first payment being March. And what an excellent way to start the new year, with a little bit of a budget reprieve. Take a payment vacation, and so that kind of stuff really really helps. And then if you find your mortgage statement, and on your mortgage statement you'll see something that says escrow balance or something to that effect, and that's where they're going to disclose how much money you have available to be applied toward your next homeowner's insurance premium or your property taxes. And so hopefully that number is a positive number. It's typically, somewhere around a couple $1,000. That's kind of in there at all times, sometimes more, sometimes less. But as long as it's a positive number, then that's another benefit, is after we close, in a couple weeks after that money gets refunded to you. And I always get the phone call from the client asking me, like, hey, I just got this check in the mail. It's for like a couple $1,000. Is it okay to deposit it into my account? Like, what is it? And so that's where that money is coming from. It's a refund of your current escrow balance. And then in the new loan, we'll take, basically some of the equity to fund the new escrow balance. So even without accessing a cash out loan, you're getting not only the budget reprieve of the payment vacation, but you're also getting the refund of that escrow balance. So it'll be, a lot of different, budget friendly things happening just naturally with the refinance. Now, obviously, if somebody is going after taking out equity, if they're trying to take out some cash, whether it's to consolidate debt, to fix up the house, to do, whatever, make a big purchase, whatever it might be, then at closing, you'll also get a large check from the title company. But afterwards, again, a couple weeks later, you get that additional check for your refunded escrow account. So wanted to go over that a little bit just so there's some understanding there. But besides that, and I see there's some mortgage folks in here. If there's anybody that's a lender or a real estate agent, definitely reach out to me and I'll get you invited on our next trip. Like I said, this week I'm going to be going up to the UWM headquarters. So if you want to have a free trip to go up there, we cover airfare, hotel, transportation, some light entertainment. It's like an open bar with some fun activities. So if that is of interest to you, or if you know a loan officer or a real estate agent that might enjoy that, introduce them to me and I'll get them invited on the next trip. So I appreciate you guys being here. But with that, what other, topics would be most helpful for you? So last Friday we were talking about real estate investing, and I have some strategies on how you can pick up investment properties, even commercial properties, with very little money out of pocket. So if that would help, love to go through that. It involves a motivated seller, right? So you maybe not finding the perfect property. You're kind of looking for the perfect situation where there's, equity in the house that you're buying, typically, because we're asking the seller to carry back some of the financing. But you can pick up a property with very little money out of pocket, and I'm able to bring 60% of the funding, so they're likely to consider it. To say, let me point it out as a comparison. If you were to ask somebody that you want to buy their property and you were offering whatever cash you had down, let's say you had 5 or 10% down, and they had to carry back 95%, that's not going to be as attractive as if I come in and provide some financing for you to offer them 60% that they're going to get up front, and then they're going to also accept payments for the remaining 40%. So it's basically just sweetening the pot in between offering just terms. It's not as good as offering 100% of the funds that they're looking for right now, but it's kind of a bridge in between. And this way you can pick up, the cool thing about being able to pick up investment properties with very little money down is that you're able to just pick up a lot of them. So as long as you're cash flowing even a little bit, then if you're investor minded, you want to just kind of keep your foot on the gas pedal and get a portfolio of them, because eventually you pay the loans down or interest rates go down and you refinance it down. Rents eventually might go up. There might be multiple purposes for the property that you pick up. As far as, the example I've given is you don't necessarily have to rent the garage to the tenant that's renting the house. So you could have a tenant rent the house. You could have another tenant renting the garage as storage or for a workshop or, a dual purpose. Let's see, move or do home addition. So I'm going to bring up 2 loan programs for you to consider when you're considering, do I go and get another house, or do I fix up the house that I'm in to make it the house that I want to live in? So obviously there are rehab loans where we could refinance the cost to repair and fix up the house. If you wanted to put on a big addition, or if you wanted to do a major remodel, maybe the kitchen or bathroom or whatever, you want to just bring it into the current, state of things that are available, the higher end countertops and, I've seen some pretty cool showers and things. So, if that's what you wanted to do, we can certainly finance that. We can do it a few different ways for the fix-up. One is we could base it off of the future value and be able to pull out some money to fix it up, even if there's not much equity in it now, if we're really going to be increasing the value of the property, but we'd have to prove that. The more likely way that it happens are one of 2 ways. We do a refinance where we take the as-is value and we just pull whatever cash we can and put that towards the fix-up, or leave your current loan in place, get a home equity line of credit that goes up to 90% of the, you can access up to 90% of the home's value, and then you're able to use that line of credit to go ahead and do the repairs. And then with moving, a very common program that is helpful for folks is called buy before you sell, or a bridge loan. That means you can use the equity in your current house, use that as a down payment for the next house, and not have to debt ratio, not have to include your current mortgage in the approving of that situation. And then they give you 6 months or 12 months to sell your house Let's see, which is smarter. I mean, honestly, um, it depends, right? Like, what location is going to work better for you? Where do you work? Where do your kids go to school? Like, um, you know, I would personal preference. I would likely move over doing rehab. I just, things are so expensive right now. Material and labor is so expensive that I don't know that I would get the equity gain out of pouring more money into a current house. So I think people that do that, they're somehow emotionally attached to the property they're in, or they just really don't want to move because it's a headache. So that's where people generally will do more of the fix up. But if you're like me and you're not emotionally attached to where you're living, then it might make more financial sense to just move to the next property that has the stuff in it that you wanted. Let's see. Jazz said, what is required if I want to buy another house and rent the one I live in? So when we go to buy that next house, we're going to assume that you're going to get a certain amount of rent for the house you're exiting. And then during that process, you need to go and find a tenant that's agreeing to come in and rent your property. And let's say they are going to rent the property for $2,000 a month, just to give a number. Your your mortgage payment will only be reduced by 75% of that of the rent that you're getting, because they're trying to figure out if there's going to be vacancy. Obviously tenants leave at times, and you'll have time without rent being collected. So if you have a lease for $2,000, that will eliminate $1,500 off of your current mortgage payment. So, and the best you can do by, renting out the house that you're exiting is eliminate the payment from the loan application. They're not going to add income to the loan. Like if you were to rent your house out for $5,000 and you only owe $1,000 a month, they're not going to say that you gain income. They're just going to say the rent is going to be enough to eliminate the mortgage payment, and that's it. So hopefully that makes sense. I can go into more detail on that if you'd like. Let's see, if the home has good bones, definitely worth keeping. Yeah, I mean, again, if there's different reasons to fix up a house, and it depends what the fix up is, like how major of the deal it is. If it's something, like some things get a higher return of investment on a house. Like if it's just one thing that we've done when we would kind of, I don't know that we would flip houses, but we would do little tweaks that seem to get a really big return. Painting is an obvious one. Flooring is, kind of quick, cheap, and easy. So if you're just, putting in new paint, new flooring, but also like upgrade the fixtures, upgrade the junction boxes, the electrical boxes, if they're like the older ones to the newer ones, it makes a big difference, and it's a very low cost way of having an impact on making a house feel new. So new fixtures, sometimes new hardware on the cabinetry, and paint is like a huge return on investment. But if you're looking at doing a major addition or something like that on a property, I would say be mindful of the fact that you might be putting more money into it than you're actually going to increase in value. That's where I'm making my my distinction, to say that I personally would probably just go and buy the house that I want rather than fix up the one I'm in. If it's not something minor like painting, flooring, even new countertops, whatever. Like that stuff is pretty manageable, where you're going to get, the enjoyment out of it, and also will probably be fine as far as, equity gain. How many months of rent would need to be collected to meet guidelines? Just one. So you don't need to even like collect a security deposit, 2 months rent, anything like that. No, you just need to show that the lease, when does the lease start, and then show the first month's rent being collected. Those are the two things that you'll need to show. And again, what we were talking about is if you were exiting your current home that you own and you're saying you're renting it out and you're buying another one, you need to show a lease and 1 month rent collected. Good question. And then obviously, if you guys have any questions, real estate or mortgage related, definitely ask them here. Again, I'm on from 10 until 11 Central Time, Monday through Friday, with the exception, like this week, I'm going to be up at the UWM campus again, so I probably won't be on Wednesday, Thursday, or Friday. But then I'll be back on the next week. And guys, like, how close are we to Christmas? So yeah, I'll be on all of next week, and then the week after we have Christmas. So yeah, I don't know. Let's see. How could family get around a loan that's not assumable and one wants to move 2.7%? So Maxwell, I think, even if it's not assumable, like it's not something where you can change the servicing, you can assign a loan in an escrow. Okay, reach out to me on that one. So, I mean, there's basically, what wholesalers do, what these real estate investors do, is they'll take over the payments of a debt without actually doing an assumption. So I think that's what you would need to do here. Now, that's obviously going to still stay on the existing person's credit, so there's some risk there, which is why you want to set up the escrow account to make sure the funds are in there to make sure that the payments are made. But that gets a little bit more in depth. But yeah, that 2.7% interest rate is a valuable thing. Is there other requirements like credit score? Obviously, credit score is always going to be an impact, but Jazz, if you could let me know in which regard are you talking about credit scores being required. I think you were talking about exiting a property and renting out the house that you're exiting and buying another one. Oh, thank you for the follow. So if that's what you're talking about, then the credit requirement will be on the purchase of your next house. Let's see, walking into work, I'll message you later. Awesome, thank you so much. Let's see, do investors take over payments using a lease option agreement? I typically no. Typically I've seen that, and so you can kind of wholesale any kind of agreement, whether it's to purchase or to rent. If you want to do rental arbitrage, I think is what that is referring to. But typically you'll assume the loan, or you'll set up the escrow account where it's assigned to you, and then it's typical for that investor to then offer a lease option, and they typically will get something like 10% down from the tenant owner, And the reason why they like those lease options is it has a very low requirement to foreclose. I mean, so it's risky for the tenant owner, and it favors the investor in that case scenario. And so hopefully they're not doing it in a predatory fashion, but typically they'll be a little bit more lenient on somebody that maybe has really bad credit. And so if they have bad credit but they have 10% to put down, they'll come in, take that 10%, and if the payments get missed, they kick them out and do it again. So I've seen that quite a bit. I don't do that, but I've seen it quite a bit because as a loan originator, and I mean, I've done a fair amount of real estate investing as well, but I will go to a bunch of like these real estate investor groups and meet a lot of investors that have questions about financing, but I also, like to learn more about what they're doing. I have to figure out more about commercial real estate investing because that seems to be where the bulk of the money that's being made happens. And I've really only done residential real estate as far as my own personal investing. It's just what I understand the best to finance. But there's, fantastic amounts of money to be made in commercial real estate. So, and right now, last I heard, commercial real estate is on sale, meaning, they're struggling with, people working from home. A lot of office space needs to be repurposed somehow. So, and I'm not an expert in commercial real estate, but I have a lot of friends that are, and that's just a personal interest of mine. Thank you very much for the follow. But yeah, any questions, real estate or mortgage related, happy to answer them. A lot of typical questions that come up are things about, down payment assistance, credit hurdles. A lot of other lenders will have an overlay, which is just their own rule, restriction to lend, where they say you need to have like a 620 or a 640 or whatever credit score. And that's just not the case with us in wholesale. You can get very little down payment down to a 580 credit score. And then if you have 10%, you can go all the way down to a 500 credit score. And they've also changed the rule on conventional loans where you don't need a 620 anymore. So, sometimes I'll get somebody that has, one of the spouses will have really good credit and the other one not so good. And that situation would typically leave us having to take one of those spouses off of the loan. But now I can do both of them on the loan and still go after a conventional approval. No guarantee that it will approve, but it now can, where it would otherwise be a hard stop. It's no longer a hard stop. So we can take a look and see if we get an approval, even if you have lower than a 620 score for a conventional loan. And that's just kind of a recent rule change. And I've seen success with it. So I encourage, if you're, if you're in that situation, just tell them to run it anyway. Or if a reminder for if you're a lender, run some of those scenarios. I saw somebody with it was like a 570 or something like that got approved conventionally. So that's significant because you're typically thinking, it's going to be a really rough deal. What do I need for a conventional? That's exactly what I'm talking about. It used to be 620 and now it doesn't have that requirement. So whatever you have, we'll run it, and then it's basically a pass or fail system in a computer program that's going to look at all of the factors. So if you make a lot of money, and you have a lower debt ratio, you're managing your monthly expenses really well, then they'll be more forgiving. Or if you have a lot of extra assets for down payment or something, they'll be a lot more forgiving on having a lower credit score. So we just need to put your scenario into the computer program and it'll be a pass or fail. But it's not, there's no longer the 620 credit score requirement. So I'd say let's look and see what we come up with. But yeah, the example I was just giving was somebody had about a 570 credit score and still got the approval conventionally, which is, does it require more down payment? No, but it might approve. Let me just say it this way. If it doesn't approve, right, and then you put more down payment, that could switch it from not approving to approving. So, but, we can start with, with 3% down conventionally and just see if it says yes or no. If 3% doesn't go, then we can up it to 5%, 10%, and so on in 5% increments. It gets better and better, but or more likely to approve. And then, also another thing that I really love is if you have good credit and some down payment, 10% or more, it's pretty common to see an appraisal waiver. And when you get an appraisal waiver, you don't require an appraisal in the transaction. It saves you the time and money. Where appraisals are typically, $600, $700, $800, depending on what loan type and where. But you save that money and the time, where a lot of times we're just waiting for the dang appraiser to get out there and do their job. Especially in, more remote areas or, this time of year where people are taking a lot of time off. So that's kind of nice to be able to skip that piece of it. And then also, let's see, so what loan products are available for USDA loans? What terms? Typically, I don't know that I've ever written a USDA loan that wasn't a 30-year fixed. And, one of the reasons for that being USDA is really strict on your debt to income ratio. So where you can go above 50% debt ratio with FHA, USDA, if it's a manual underwrite, only goes up to 41% on the back end. That doesn't mean anything to the to the average viewer, but basically you can use a lot less of your income to approve for a USDA loan compared to other loans. And therefore, you typically want the lowest payment to be able to approve for it. So even if they allow, a 15-year or whatever, typically because of the debt ratio restriction, you're probably going to want to just go with a 30-year to get the amount of loan that you want to approve for. And then if you want to pay it off early, go ahead and, pay over the minimum payment. So that's, and I write quite a few USDA loans, I'd say, compared to most. So I probably do, 10 or so per year. And, most of my coworkers might not ever write them. So, or just one here and there, like maybe one a year or something like that. They're just not as common as conventional FHA and VA. I don't typically run into a lot of jumbo. I probably only do one or two jumbo deals per year. Reverse, I probably do a handful of reverse mortgages per year. So those are some of the lesser common loan types. And, the bulk of them are conventional VA, FHA. So that's just kind of what I see. That's totally anecdotal. Oh, wow. Thanks for all the likes, you guys. Holy cow. Um, Whoever did that, thanks for beating the hell out of your screen. Over 1,000 likes. I didn't expect to see that. But yeah, so that's some take on USD. USDA is a great loan too. I mean, it has reduced mortgage insurance compared to FHA, and obviously no money down versus 3.5% down. It's a little bit harder to get the loan because it does require so you have the same. Oh, I know what it was. So, like if you're out and you have like well water, it requires a water test in addition to having the house qualify to government standard, which government standard for USDA is the same for FHA and VA. You can't have things like chipped or peeling paint. You can't have like a missing handrail. Like the house has to be in good enough condition. But there are fix-up loans on all the different government loan types. So if you found a house that just is needing a little bit of disrepair, you can do a rehab loan. It's going to make the interest rate a lot higher. So I mean, if you can, maybe if it's a small thing like a little chipped and peeling paint, have the seller do it or agree that it gets done prior to close and just negotiate that in the contract. That's kind of stuff where I can hold your hand on that a little bit, you and your real estate agent, and I can provide a little guidance just out of years and years of experience. And then another thing, all government loans have a form of a streamlined refinance, meaning you don't need to get an appraisal, you don't need to re-verify your income or your assets. You can just refinance it if rates go down, including USDA. So that's another big advantage to those loan types, especially right now where I think we're going to see interest rates continue to decline over the next year and maybe beyond. So we'll see. I don't have a crystal ball. I just have, let's see, what's the minimum FICO for USDA is, I believe it's 550. That's the lowest that I know out of my 200 plus lenders. Some of them have overlays where it's a lot higher, but you can get down to a 550 credit score and buy a property with no money down, USDA. So that's a pretty good deal there. Yeah, that's, I mean, thinking about, down payment assistance programs, nothing beats VA. VA is the strongest, but you need to have served the country and earned your entitlement. But second to that, I'd say USDA is the best, is because when you get into down payment assistance programs using a conventional loan or FHA, there's typically some kind of a cost involved where it'll increase the interest rate or the closing costs or both. And then sometimes you have repayable second mortgages and forgivable second mortgages on some of those other loan programs, especially FHA. But yeah, USDA just by its nature is no money down. Got your text message, Kaja. I'll be happy to return your call. Thank you for being on here. Yeah, but no, as far as down payment assistance programs go, it's a fantastic option. But then for those that are just not in that geographical area where it exists, there's so many down payment assistance programs right now. Are DPAs second mortgages? Not always. A lot of times they're grants or gifts as well. So like the last loan I closed was a 2% grant or a gift. I forget which. But, it's a 3% down payment conventional loan, and then it comes with a 2% grant or a gift from the lender. So it left him with 1% down payment on. So he bought a 300 some $1,000 house for only $3,000. Pretty good deal. If you think about how it compares to rent, getting into a rental for less than $3,000 is difficult because they're going to usually take a security deposit, first month's rent, maybe first and last month's rent. Hi, are you able to help with affordability, whether or not I can afford the house I'm looking at? Yes. Some of the affordability options are, buying a place with more than one person. So that could be, having, if it's a friend or a family member that goes in on it with you, you can both be on the loan. If you are buying a duplex, 3 or 4plex, you can use the future tenant income on those other units, and that helps a lot with affordability. Typically, when I get the phone call, it's just me looking to see if I can afford this house based on my income. Yeah, so with that, I would say reach out, text me, and just say price check, something like that. I'll send you the loan application, and then basically get to your debt to income ratio and let you know if it approves, if so, by how much, if not, by how much. And then we can see for that specific thing. But as far as, what I was saying before with affordability, if I get somebody reach out to me and they're like saying, look, I want to get the cheapest thing possible, whether that's a manufactured home or a condo, I just want the smallest monthly payment possible. I always bring up in that conversation, getting a multi-unit building, and let's look at the numbers. So, I'll just pull up where they live. I'll look for multi-unit properties, and I'll put some numbers together and see if that might get them to a lower monthly budget using the rent from somebody else. Now, it does require you to be a landlord, but some of the advantages there is, let's say you buy a $100,000 condo. Well, your cost basis of $100,000 will appreciate over time if we're going to see continued appreciation in real estate. I assume yes. But then your cost basis is $100,000, and then if we see 2% inflation, then you're going to go from $100,000 to $102,000 year over year. But if you buy a multi-unit place where you're collecting a bunch of rent, your cost basis might be, $500,000, $600,000, $700,000, and then your 2% is going to be based off of that higher number, when properties are going to increase. So you're going to see a lot more appreciation. There's a lot of benefit there. You're going to have some tax breaks you otherwise wouldn't if you become a landlord. So, and then plus, hopefully, the situation works out where your monthly cost basis is much lower. But you always have to be cognizant of the fact that you're now when it comes to repairs. So something breaks, it might be, just make sure that you're sitting with a comfortable savings if that's the route you're going to go. I'd hate to see somebody be set up for failure. And so I walk through all of those kind of, let's make sure we're sure-footed in the direction that we're walking. But yeah, I look forward to seeing what you got going there. I know with FHA is the most lenient besides VA, right? So I don't know if you're a veteran or not, but assuming you're not, FHA is the most flexible as it comes to being able to get the most amount of pre-approval for the same amount of income. So we can take a look at that and, discuss some options. The only time when FHA gets beat out by conventional is when you have no other debt, right? So you don't have a car loan, you don't have a credit card or whatever. If you have no other payments, then you can approve for more house with a conventional loan than with FHA. but we'll take a look at it and see what makes sense. And we've got about 9 minutes left in the hour. So if anybody else has any questions, comments, well wishes, or detractors, even, all comments are welcome. Again, I'm on here Monday through Friday, 10 a.m. to 11 a.m. Central Time. So feel free to, if you know somebody else that is looking to either buy or refinance and might have some questions, share this with them, or just let them know to come on during this hour. And I'm happy to answer any questions they have. For the folks that are here now that we're not on at the beginning, if you see over my head, if you have a loan scenario you want me to price out, I'll price it out live. So I'm not just telling you that my rates are really good. I'm showing you. And you can't really see it right there, so I'll blow it in. There we go. So you can see all these different lenders that we have, over 200 lenders that we price out. I'll put your information in one time, and the best price goes on top. And so that's just kind of where brokers are giving you a price advantage, because lenders are going to price out differently all the time, every day, in every loan program, right? So whatever your situation is, I don't even know which lender is going to be the cheapest. I need to do a cash out refi ASAP. My credit is perfect. Loan to value 60%, DSCR ratio is 1.21. That sounds like something that any lender can do in their sleep. So I'd love to be able to help you on that. Again, I reduce my fees to give excellent pricing. If you want, I can price that out for you right here. First, I have to shrink this to, let's see, do appraisers always do a 1007 on USDA loans. A rental survey. No, I mean, USDA is that's owner occupied only. So, have you ever seen an appraiser do a 1007 on a USDA deal? I haven't. So, I do quite a bit of them. Let's see, let's modify this. I'm going to go to, what was it, 796. And we'll go to DSCR, cash out refi. What do we say, 60%? And little cash out there. I got you. Do appraisers always do a 1007 on DSCR loans? I think so. I've never done one where they didn't. But maybe some will just take the lease. Problem is finding lender who won't police how the property is being used long-term versus short-term. Awesome. I mean, I have so many lenders in wholesale that will literally justify your rent based off of air DNA. Like they're really lenient. So I also have no ratio loans. So even if you didn't have the 1.21 ratio on your DSCR, let's say you had a 0.75 or even lower, I have lenders that'll do that as well. Obviously the rate isn't as good, but since you have a good ratio, that'll help your interest rate. And that's what I'm working on finding out here right now. I'm going to just leave the property in Texas. It's going to be, maybe a little bit different per state, but, I'm not sure where you're at. So I just wanted to get some pricing worked up here to give you just kind of an idea of what we would be looking at. Income verification. Where is it? Investor DSCR, which I'm going to change this to investment. I'm assuming a single family home. It might not be or whatever. Let's see. And then DSCR 1.21. And let's take a look. That's what I need. Taxes 8,500, insurance 7,100 total. That's really high insurance. Insurance is a killer. Let's see here. I got to modify this. Let's go rate. Oh, welcome to Florida. Yeah, I know. And so you probably saw a huge increase recently. The year over year has been rough over there, as it has been in a lot of areas, but they've just been really hammered with all the storms. I'm just walking this up here a little bit. So it looks like 6.5% gets us costing 1%. So we can go up from there and get to some par pricing, which means no lender fees. But yeah, this looks, and that's with a lender that does a pretty good job. If I modify this a little higher, say 675, see what other pricing options we have. Gets closer to par, but yeah, you're going to be likely in the mid sixes for interest rate, and then we can get this thing pushed through as quickly as possible. You're ready to go, then definitely reach out. My phone number, just text DSCR so I remember who you are. And then I'll get you the loan application. We'll get you put in. I'm looking at the calendar right now. Let's see if we could likely get it done prior to the Christmas break. So we have like a full 2 weeks. So if we started today, we could probably close as soon as next Friday at the soonest, is my guess. But if we really want to boogie on it, to do it before the holiday, because everybody's going to take time off, that third week of the month, it's just going to be a nightmare. It's going to be appraisers, title companies, my staff, everybody takes time. This is long-term financing, correct? Yes. Yeah, this is a 30-year fixed is what I was quoting. We could look at an adjustable rate or whatever and see if that makes more sense. But I just quoted 30-year fixed. Does the property tax depend on the amount of the price of the house? Yeah, it's the assessed value, right? So every county has, an assessor, and they're going to go out and say, we think your house is worth X. And then you have an opportunity to say, are you kidding me? What are you talking about? It's not worth X, it's worth Y. And you can come in and you can fight them on lowering the value so you can pay less taxes. Always do that. I've certainly been doing this long enough to see the people that have done that. It's worked. I'm like, wow, how are your taxes so low? And they say, because I contest it every year. So yes, answer to your question is yes. If the assessor tells the Treasury that your house is worth $1 million, then they're going to tax you at the $1 million rate. So hopefully that answers your question. I'll stay on for a couple more minutes if you have any other questions, but we are now past the hour, and happy to answer any questions you have. Otherwise, thank you so much for the participation. It always makes it a lot more enjoyable for me when we're having a conversation rather than me just word vomiting at the camera for an hour. So appreciate the participation there. Appreciate all the likes, the follows. This has been a very good Monday. Typically Mondays are a little bit slower on here because I take weekends off. I'm always, you're very welcome. Thank you, Martha. And thank you for the follow. Multiple follows. Thank you. So yeah, if let's see, do you know how DSCR ratio is calculated? Yeah, so you take whatever the rent is, right? So if the rent is $1,000, you take 75% of that, which is, and I got your text message, thank you, which is $750. So then they take the ratio between that $750 and whatever the monthly payment is on the new mortgage. And that's going to get you the ratio. So if the payment, the mortgage payment was $750 and the rent was $1,000, we would take that $750, which is 75% of the rent, versus the $750 that the mortgage costs, and that would be a 1% ratio. If that doesn't make sense, you can reach out to me and we can work on the math until it makes sense, but that's the calculation. And it's a good question. Hello, I received an approve eligible. Is that a good thing? I'm waiting to go in underwriting. Yes, that is a good thing. That's basically where I was talking about before. There was somebody that had a lower credit score. And I was explaining that, they got rid of the 620 requirement for a conventional loan. And so what we need to do is look and see. And so what they did is they ran either a Fannie Mae or a Freddie Mac approval. And that's exactly what it says when it approves. It says approved eligible. So that's where you're at right now. It means that you got a stamp of approval based on the information put in. As long as none of that changes or gets any worse or different, you're going to be approved by Fannie Mae or Freddie Mac based on your current situation. And then in underwriting, they're going to update, the income might get recalculated a little bit. They might, maybe you put in $10,000 for what you had in the bank, but it's actually $9,962.29. They update all those fine numbers, and then they'll rerun it, and hopefully you maintain your approvability, and congratulations, that's good news. This might be an off-topic question, but have you ate breakfast? I don't eat breakfast. So, formerly a very fat guy, I intermittently fast. I take GLP-1. No, I don't eat breakfast. But I do have lunch plans, and so in about an hour or so, I'll have my first meal of the day. Sometimes that's my only meal of the day. And no topics are off topic here. This is just an open forum conversation. Do they still do a credit grade without the FICO? Some loan types, yes. But typically no, for like your VA, FHA, USDA conventional. Those credit grades have to do with non-QM loans like DSCR and some of these other, bank statements as income, all these different kind of loan programs deal with credit grades. So awesome, guys. Thank you so much for the participation. I'll be back on tomorrow at 10 a.m. Central, and hope to see you guys there. And I hope to figure out how to get my headphones working. So I'm going to play this outro tune here as I always do, but I don't know if it's going to sound right because I need to fix my audio. But you have a wonderful day, and I look forward to talking with you again. Make it a great day.